Hi everyone, it's Brian Walsh from This Week in Impact. It's Thursday, August 1st. The ImpactAlpha team is off this week for summer break, but we wanted to make sure you had a great podcast to listen to in our feed. And we have just that, an episode of Capital Gains, the latest addition to the ImpactAlpha Podcast Network. Capital Gains co-hosts Matt Posner and James McIntyre speak with leading thinkers in community development and public finance, exploring how decisions are made, policy is enacted, projects are funded, and what it all means for people and communities. In this episode, James and Matt speak with Carolyn Kousky, a leading policy expert at the Environmental Defense Fund. As the Earth just recorded its hottest day on record ever, it's an important and timely conversation. Be sure to subscribe to Capital Gains wherever you listen to podcasts so you won't miss a future episode. And we'll see you back in this feed for more Impact next week. Thanks.
Welcome to Capital Gains, where we turn government policy and politics into your financial insights. You have two hosts today. One of them is myself. My name is Matt Posner.
And I'm James McIntyre. And welcome to Capital Gains.
Capital Gains is a member of the ImpactAlpha Podcast Network and can be found on impactalpha.com/podcasts or at courtstreetgroup.com/Capital Gains. Capital Gains is also available on iTunes and in the Apple Store.
From wildfires in California to hurricanes battering the Gulf Coast, natural disasters are on the rise, as are our seas, fueled by undeniable force of climate change. And as these events become more frequent and intense, the financial strain on state and local governments is reaching a breaking point. But beyond the immediate damage, there's a looming shadow, the skyrocketing cost of insurance. Today, we'll dive deep into the harsh reality of rising insurance costs, the impact on state and local budgets, the lack of clear federal guidance on perhaps the long-term climate solutions. News of the major property insurers declining to write new policies in California and Florida last summer appears to have jolted the nation into having a more serious dialogue about the way in which people, governments, and business operate in light of increased climate volatility. Essentially, no business transaction occurs in a modern capitalist country without some sort of insurance. This industry generally, quietly permeates all aspects of our lives. The news last summer was shocking, but to many who follow the space, this was a long time in coming.
Our guest today is Carolyn Kousky. She is at the very forefront of disaster insurance and is also quite adept at making these complex issues digestible to most of us who don't follow them on a regular basis. Carolyn is an associate vice president for economics and policy at the Environmental Defense Fund. Aside from going over the risks, we're going to ask her some of the crucial questions about what solutions do we have to the problem, and if left unaddressed, what kind of costs we're looking at, and also how do we transform communities in the years to come. So buckle up. This is a great episode for the very real financial storm brewing across our nation and the urgent need for answers. We're calling it On Borrowed Time. Before we get into it, James, I spent the morning at a building resilience conference put on by the Chamber of Commerce today. The keynote was the head of NOAA, and he informed us that this past April 2024, was the hottest April ever, making it 11 consecutive months in which we've had the hottest month ever on record. And our guest, Carolyn, she also referenced this data point from a month prior. Speaking at the conference, though, this was interesting, was the general counsel of State Farm. At the end of his panel, they asked, what's your call to action? And his was the need to engage local governments, which was refreshing. There was definitely a lack of local government stakeholders at this conference in particular. What do you think, after listening to Carolyn, and obviously you follow this topic, what is the intersection of local government, insurance, and natural disasters, in your opinion?
Well, as they say, like real estate, everything's local. And I think that when it comes to where water flows, what water looks like on your property line, there's nothing that we need to do and look at on both a macro level and at a scalpel level to solve this. And a lot of that will run through state and local governments. Carolyn does an amazing job of sort of connecting the dots, I think, in her thinking around that. Also this morning, there was a really interesting conversation at the State Housing Finance Agency in New York about part of its work was putting around $15 million into marsh reconstruction in Long Beach, Long Island, as part of some mitigation strategies. And the question I actually asked in a meeting was about what conversations are we having with insurers around, is what we're doing going to fortify these buildings? Are these the best practices? How do we think holistically about what we fund and connecting the dots between these large infrastructure investments and sort of the built environment that will be impacted, perhaps mitigated, and benefit, or perhaps put it further at risk if no action is taken? This connectivity and discussions of these topics is emerging everywhere. And I think that that's why, I'm excited about the conversation we had with Carolyn. As I said, there's no person I think that we could talk to that has better expertise and has written more. And I really like her narrative about this being the hottest month. So without further ado.
Joining us today is Dr. Carolyn Kousky, the Associate Vice President for Economics and Policy at the Environmental Defense Fund. We asked her just before starting, and she prefers Carolyn, so we will refer to her as such. Carolyn's research examines multiple aspects of climate risk management and policy approaches for increasing resilience. She's widely published and has written a book on her own called Understanding Disaster Insurance. And I might add that the very first chapter, she talks about making more insurance more commonplace, the topic more commonplace at cocktail parties, something that James and I share when we try to get people excited about municipal bonds. The book offers innovative ideas and makes insurance a more palatable topic and helped me a lot when I think about the risks of the world we live in.
Hey, Carolyn, thanks for coming on the podcast. To start, what's going on with our Earth and what frightens you most about climate change?
Yeah, that's a big opening question. Thank you both for having me on. I'm delighted to be here and chat with you both about this topic. I think what worries me most is that we are now in this period of ever-growing risk. We're not going to get in the near term to some new plateau. There's not some new standard we can design to that will solve everything. It's that risks are going to keep growing, and we, meaning individuals as well as our public and private institutions, I don't think are very good or well designed to address that. You both hear this a lot, like I do. There's always this kind of drumbeat of record breaking. I'm sure you might have seen recently, as I did, that March, this last month, was the 10th hottest month on record, meaning for the last 10 months, each one has been a new record-breaking month. I just wanted to offer this reframe that I'm going to steal. I heard John Podesta last fall say this, and somehow this reframe just really hit home for me because that record-breaking is kind of, I feel a little numb to it. I don't know about you both, but he said, yeah, this was the hottest winter, but it could very well be one of the coldest you experience. And thinking about it like that kind of woke me up a little bit to remember, oh yeah, we're in this scary spiral right now.
Before we get into the rest of this, I'm just kind of curious, a little bit of your origin story, if we may. You have a bachelor's in science and earth systems from Stanford and a PhD in public policy from Harvard. How did this start? And then I guess, how did you find insurance?
Yeah, how does anyone find insurance? I knew way back when I was in middle school and high school that I wanted to focus on helping improve the way we treat the earth and address sort of environmental challenges. So the earth systems degree was obvious for me. My time as an undergrad, I had a thesis advisor, the late Stephen Schneider, who was a fantastic, phenomenal climate scientist. But he was the one who really introduced me to the importance of risk management and how we think about uncertainty and how we manage uncertainty and make good decisions in the face of risk. And that interest just really stuck. I got really taken with how we handle risk, particularly risks where there's a very substantial downside, right? So that's kind of stayed with me for my career. I started my PhD program. And as I was getting to work on my dissertation, which was going to be on a totally different topic, Hurricane Katrina hit. So that was, 19 years ago now? And I got pulled into a project looking at the role of wetlands in buffering storm surge, but got really fascinated by the recovery happening around Katrina and a lot of the challenges and difficulties and heartbreaking stories coming out of how we handled that event. And so that kind of led me into disaster and into flood insurance. But back then, very few people thought flood insurance was as interesting as I did.
How vulnerable are we as a planet, as a country, to the coming climate change around us?
I think we're very vulnerable. And I think part of the problem, to keep going with this risk management thread, is that risk is really tricky for people, right? I mean, you both know this, but you can't see risk. It's not tangible. Most people don't measure it. We have really sophisticated measurement tools, but most people don't have access to them. We do, in my opinion, a terrible job as society talking to people about it. And then we know from all the kind of behavioral economics and psychology work that just our innate nature tends to be, not everyone, but on average, we tend to be overly optimistic, very myopic. Our public and private institutions are not built for long-term thinking. These global risks that we face right now, whether it's climate or biodiversity loss or any range of things, where kind of risk reduction is a public good that requires coordinated action, are the hardest of all. So it's not surprising that we haven't been able to manage them well, right? And whether that's a decarbonization or the climate adaptation to make ourselves better able to handle what's coming.
You're touching on something that's really important, is sort of the education and understanding, which, as I said earlier, you talk about in the sort of the intro to your book. And maybe it'd be a good idea here to sort of set the stage. Let's talk about insurance. What type of insurance do we have in this country? How do they work together? I think that would be helpful for listeners that aren't as up to speed on disaster insurance, but just insurance in general.
When we're talking about disasters, we're usually talking about property and casualty insurance, which is in contrast to like health and life insurance. Of course, there's some really interesting emerging conversations now about how climate's going to be impacting health and maybe health insurance. But most of my work has focused on sort of property insurance. And if we're focused on, say, individuals or households, what we're primarily talking about is homeowners insurance or renters insurance, but very few people have renters insurance, and almost all homeowners do have homeowners insurance. You're required to have it if you have a mortgage. Most people keep it. It protects against a range of risks. Unfortunately, it doesn't protect so good about disasters. So floods have been excluded from your homeowner's policy going back over 50 years now. So if you're at risk of flooding, then we have a separate program for you. And that's actually managed by the federal government because the private sector walked away from flood, as I said, a long time ago. So we have separate flood policies. And what that means is in the United States, there's no such thing as hurricane insurance, which is a little frustrating for people who live on the coast, the Gulf and Southeast coast, who would really like specific hurricane protection. You have to have a flood policy for the storm surge and the flooding, the rainwater flooding, and you also have to have a separate homeowners policy to cover wind. And then on top of that, where risks are getting too hard for the private sector, and we can unpack that more, we not only have the federal flood program, we have state programs for disasters. So every state prone to hurricanes has a state program for residents who can't find homeowners coverage or wind coverage in the private market. We have state programs for wildfire in California, Colorado. So it's this mix of public and private sector programs.
It seems like it's very fragmented, the insurance, especially when it comes, you talked about that in your book, Understanding Disaster Insurance. What are some of the other aspects that are wrong effectively with disaster insurance coverage in the United States today?
Well, one of the challenges that we're seeing recently is that while there's already this fragmentation, people tend to assume that homeowners' policies are all pretty much the same. And in fact, I have a law professor colleague who's done some really good research documenting that homeowners policies are actually really heterogeneous. They can have really different types of coverages. And when it comes to disasters, there can be lots of hidden problems in them or limitations in coverage. So a good example are something called sublimits, which are you insure your home maybe to value, but if the loss is a certain kind, oops, the insurance company isn't really going to pay you for it. So you might have $200,000 of coverage on your home, but if it's hail on your roof, they'll only give you $5,000. Or if it's burst pipes, they'll only give you $5,000. Or if it's mold, they won't give you anything. And so there's all these things that kind of cut up your policy, and consumers are often not aware of those until they go to rebuild, and then they find they don't have enough money to rebuild.
So it's the small print that's the problem.
The small print. It's always the fine print, isn't it?
Last year, at least 20 property insurance companies have announced some sort of limiting of their coverage. And nearly all of them had some reference to increased natural disaster risk as their reasoning for these changes. I think I'm someone who probably was looking for these headlines, but there appears to have been something last summer. Obviously, it was Allstate and State Farm in California with wildfires. There seemed to be a major focus by the media on what was happening. And what I haven't really had properly answered, and I'm hoping you can offer some insight, is what happened in the summer of 2023 that was so distinct? What's happening now that it seems like it's acted as a catalyst to a lot more focus and a lot more concern about what these risks really mean for the country going forward?
It might be maybe a bit cliche to say we've had a perfect storm of impacts in property markets the last year or two. I think things were building several years before that. And then we've sort of hit some like waves. So let's talk through that. But I want to first ground it maybe by saying that I think there's two big difficulties that insurers face when it comes to disasters, climate-related shocks, which is correlation and catastrophe. So the problems for them are that when a big climate-related disaster hits, lots of people get hit by the same time. And when they get hit, it can be really, really bad. And insurance is actually, you'd think it's built for that. It's not built for that. Insurance is actually built for things like car accidents and the random tree falling on your house or a burglary, where it's like someone gets hit every year. It's never the same person. People aren't hit all at once. And there's really beautiful mathematical laws that make pooling risk. And I think the point when that really shifted was actually the 2017 and 2018 wildfire seasons in California, when insurers lost. Some colleagues at Milliman put together this nice analysis. Those two wildfire seasons wiped out more than a quarter century, twice over, of cumulative underwriting profits for the entire homeowners industry in the state. That's just like not a profitable business model anymore, right? And then all the disasters that have just come since then. So in some sense, we were kind of building up with these really big climate impacts. But what also happened the last couple of years is that the cost to rebuild got really a lot higher. And that was because of the period of high inflation we had. It was because of supply chain disruptions, increasing materials costs. It was because of labor shortages in the construction industry that made rebuilding costly. And those really started, like going back maybe to the pandemic, but it took a while to work into the system. And that's led to higher premiums around the country. But I do think like where we're seeing things bite the most are in the areas of really high climate risk. And so to just kind of rattle off some impacts in the market, we've seen the last 3 years, say, bankruptcies. 12 insurers in Louisiana went bankrupt. I think like 9 in Florida, 5 were liquidated in 2022. The higher prices you mentioned all around the country, price increases in the highest risk areas, sometimes in the double digits. The pulling out of markets. You guys mentioned State Farm, Allstate leaving California. I'll say the big name insurers left Florida a while ago. This reduction in coverage. And then all of that is culminating in this shift of risk from the private market into these public sector programs we were talking about. And so the California state program, the Louisiana one, Texas, Florida are all seeing an influx of policyholders into their state programs.
I've seen you speak in various capacities about parametric insurance, specifically New York City post-flood financial resilience of low and moderate income residents. You've also published something recently on community-based catastrophe insurance. What are the best solutions for this, given that all these big players have moved out?
That is the really hard question we're grappling with right now. I want to say before delving into some of these kind of new insurance models that it's going to take policy change, regulatory change, and some new models. So these new models, I think by themselves are not the complete answer, but I think they provide some interesting things. So let's kind of talk through what some of the options are. I think they fall into a few categories. So our standard insurance, like your homeowner's policy, is what's called indemnity coverage, where you get paid the exact loss. Parametric insurance, on the other hand, pays based on what's referred to as a trigger, which is some observable metric, an independent measure of the hazard. So think wind speeds within so many miles of my house exceed some threshold, I automatically get this much money in the bank. They've been around since, I don't know, at least the 90s, but there's been some interest lately in how to harness that to what I think of as filling holes in our safety net. So it's not a replacement for homeowners coverage, but there are lots of other gaps. And so these new models can be used for things like immediate needs right after a disaster because they're fast and the dollars are flexible. It can be used to provide sort of baseline recovery for households who can't afford anything else. This has been used actually globally around the world through microinsurance products to provide financial protection to lower income households. It's better for renters whose main losses are not property damage, but things like higher rent spiking after a disaster. It can be good for things like lost revenue for businesses or local governments. So there's a lot of other niches that these kind of parametric products can play in. When it comes to actually making a homeowner's policy more affordable and provide more coverage, I think that's when we get into the conversation of we actually have to lower the risks. We have to make the homes stronger, better able to withstand disaster. We know how to do that, and then they become easier and cheaper to insure.
Can you talk a little bit about FEMA's role? I mean, we're seeing bigger storms, more expensive storms, private insurance exits. So how does FEMA, even not just FEMA, but just generally like in other states, like state level insurance, like government becoming the insurance backstop that everyone seems to be thinking is there? So is that sustainable?
So to start with FEMA, right? So FEMA is like government first responder for big disasters that get a presidential disaster declaration. FEMA houses our flood insurance program, but they also manage the sort of emergency disaster aid that the president can authorize. And that's aid to both households and to local governments. There have been lots of different challenges in this process. So the first is that the aid that FEMA gives to households, it's very limited. It's on average a few $1,000s. It has a cap. It's to make your home safe. Again, it is not to bring you back to pre-disaster conditions. It does not make people whole. That's just how the program's designed. It is not designed to replace insurance. But there's also been a lot of research the past few years sort of documenting a lot of procedural inequities in it, that the dollars tend to go to richer and whiter communities and the communities who don't need it as much, right? And the ones who need it the most are kind of getting locked out. Now, I will say recently under the Biden administration, FEMA's made some really important changes to that program to make it easier to get the money you need, to have everyone get the money they deserve and get it to them faster. Because another challenge with disaster aid has been the timing. So FEMA comes in, right, and provides it. For a long time, though, and this was just recently changed, you had to actually apply to a loan before you could even qualify to get the FEMA grants. That adds a bunch of time and confusion. That was really problematic. And the big dollars that you see headlines after a Hurricane Harvey or whatever, that Congress has authorized a bunch of money, is often not always administered through FEMA, but also through HUD, the Department of Housing and Urban Development. And most of it goes to kind of local government and state governments for all types of repair, not to households. But that money can take literally years to get spent in a community. And so what we see is this kind of gap in the immediate term. And now, just to kind of link this back for a second to the innovative insurance stuff, right? So one challenge that we saw, and this comes back to the New York City example that I didn't really talk about, Matt, that we were seeing that like after a big flood event, even if FEMA was authorized to spend dollars or HUD was authorized, that households didn't get money in the first few weeks or months. And for more affluent families, that didn't matter. And so that was one of these holes in the safety net that parametric insurance is well positioned to fill. And so we worked with a bunch of partners there, the Center for New York City Neighborhoods, the Mayor's Office for Climate and Environmental Justice, to design a parametric product that the center could use to help get those emergency dollars to households in need, which they ultimately purchased from Swiss Re through Guy Carpenter.
It almost serves as like a business interruption insurance effectively, except for households, because understanding that for especially low and moderate income folks, a flood is a major life interruption effectively.
We've seen in some of our survey research that, you know, the property damage is really visible and can be severe and really expensive to repair property. But it's so much more than that, to your point about business interruption. And we saw that up to half of residents impacted by major hurricanes, for example, did lose income because the places that were employing them couldn't operate and couldn't pay them. And then it's also things like coping strategies for when services are down, or temporary living when your home's too damaged, and evacuation expenses. It really starts to add up.
So to where we started this, the optimist not liking to see risk, is insurance, can it be like a lever and a force for change? And not to quote you, but to quote you, you said that when structured as an appropriate risk transfer mechanism, property and casualty insurance can encourage pre-disaster mitigation efforts through lower premiums for more resilient properties. And we know, like separately, that if you're not wearing a seatbelt, your claims can be impacted on insurance. Like we know that there are consequences, that insurance has changed the market fundamentally. Can that happen when it comes to the environment and climate change?
I'm optimistic that it can, but I think this is an area where insurers really need to lean in a way that they haven't, to link the kind of risk transfer of insurance with those risk reduction measures, like wearing your seatbelt while building safer. We know how to build safer in most places. The Institute for Building and Home Safety, for example, has standards for hurricanes and wildfires that withstand pretty severe events. And yet we're just not doing it often, despite the fact that their hurricane standard is incredibly cost effective. It is not that much more money. Habitat for Humanity is doing it in all of their homes in the Gulf Coast region for very little extra dollars. So yes, I think insurance should be a lever here. The pre-disaster premiums, I think, has not been as effective as one would hope. And I think part of the problem is that the reduction in premium pays back over time, right? But people need the dollars up front. And so even if with a lower insurance premium, you're going to save money over the next decade, you still need to pay for it up front. So you need some sort of strategy to get people the dollars. And to come back to some of our earlier conversations, the awareness that that's what they need to do and the broader ecosystem to support it. A roofer, a builder they can trust who charges them a fair price, who knows how to build to these standards. So it's sort of like an ecosystem change to make all of that happen. And I've gotten more interested since the book, I guess, in insurance as a post-disaster lever too, right?
And that'll stop us from basically building back the same too, in many respects.
Yes, we need to build back better. I guess lots of people say that in lots of contexts now, but it's true.
So, Carolyn, it seems to me like the incentives or the post-disaster reconstruction, a lot of this is probably going to be happening at the state and local level. Are there any particular programs that you could point to or any sort of models that could be replicated that's happened on the ground at the state and local level?
That's a really good question. And you're right, it does have to be local. A couple to hold up. One that's talked about among disaster people, I guess, is actually the state of Alabama, because they have done a lot to create these strong homes that we were talking about that can withstand hurricanes, the fortified homes. They have more fortified homes than any other state. You'd think it would be Florida or something, but it's not. It's Alabama. And they have a whole package of incentives working together. So the first is the building code, so that new construction is built strong. And so in coastal Alabama, you have to build to the standard if you have new construction. But then as we were talking about, what do you do with existing construction? Their state program will pay, if you're in their wind pool, their wind insurance program will pay you more at the time of rebuilding to go to this standard. They encourage the private sector to also pay out more to bring people to this standard. They have a grant program to pay the costs of fortifying your roof, particularly for households that can't afford it. So you have this sort of policy solutions, regulatory solutions, and insurance solutions that's all pushing it. And once you have all those, then what you also do is create a workforce that knows how to build that way, understands the standards, and community awareness that that's the way to deal with hurricane risk. And so they've done a nice job of getting all those pieces lined up. Another example that I think is interesting that's actually very different in flavor and was not actually even designed as a disaster resilience strategy, but I think now is one, although in a very affluent community. So yes, I understand that raises some questions, but there's a community on the Gulf Coast of Florida called Pelican Bay that preserved all these mangroves. And the development is behind the mangroves. When the hurricane came through, it absorbed a lot of the wind and wave energy, right? And a lot of the flooding. And so it protected the structures behind it better than places that are built right on the coast. And so I think there are ways to rethink how we build and build with nature that can provide these range of benefits and the risk reduction benefits at the same time.
Are insurers actually paying for nature-based solutions and rebuild at all?
I haven't seen them actually pay for them. The closest I've seen is a really interesting partnership in Canada where insurers have teamed up with Ducks Unlimited to fund conservation and restoration of wetlands around communities where they're writing a lot of insurance for the flood risk reduction benefits.
So James and I come at a lot of these issues from the public finance perspective. So moving from opportunities to sort of risk assessment at the state and local level, keeping with that in mind, where natural disasters have gone from acute to chronic. When we think about a place like Maui, lost something like 25% of its tax revenue in a week. Do you have any thoughts on whether local governments are thinking about risk correctly in this frame of mind?
I think that's a really interesting question. And I think we're at a interesting, problematic, challenging moment where local governments, and I should say a host of other actors too, are realizing for the first time the importance and need for what is often called climate analytics, right? Like information on their risks and how climate's impacting them and how they're changing and how you move from measures of the hazard to the economic impacts that they actually care about. Previously, the way to think about that would be to look at historical data. What was our flood on record? How often do we see floods? And now in this environment of change, that's just no longer helpful when we can start seeing events that are so wildly out of historical samples, like the Pacific heat dome comes to mind as one of those, or hazards that are also just occurring in places we're not used to, at scales we're not used to. I'm thinking about, was this 2023 too, when Louisiana was dealing with wildfires and California was dealing with a hurricane? And you're like, wait. And so I think, no, communities aren't prepared for that, for these out of sample events, for this different type of impacts. And so we have to come to models, and we have to use models to try to understand what's happening. But local staff aren't modelers. They're not running the models. And now there's been this explosion of startups offering this type of information, often for a fee. Local governments often don't have a lot of money. Where I'm going with this is to the moment that I think is difficult is how to help these new users of this type of information understand which models are good and bad, yes, but more to the point, which are fit for their decision purpose. What types of model output, assumptions going into the models, do they need for their decision context? And it's incorrect to assume that everybody just needs as fine a scale and as much information as possible, right? And so I think we have a need now for, I don't know, some type of helper.
But you're absolutely right. I mean, the need for like thoughtful technical assistance on like, here's the lay of the land. Here are your options, right? Like, who is leading in the municipal space, leading this charge are the investors, right? And
yeah, to get those price signals into the market, but also to take the risk assessments that sophisticated users like investors, like global insurance and reinsurance companies use and have access to, and make it available and translated to the local decision makers and the local businesses and the households that have to make the necessary changes on the ground in order to maintain insurability. And right now, too often there's this disconnect, right? Where insurers know way more about their risk than the policyholders. And yet that then prevents the needed changes.
I'm assuming you're maybe not completely familiar, but this month, this is April, we're recording this, the state of Florida is issuing bonds to replenish its catastrophe fund. The funds they're basically assessments on the active property and casualty insurers in the states. So the bonds are secured by the reimbursement of premiums collected by all residential property insurers in the states. I'm just reading this to make sure I got that right. It's not backed by the credit of the state or its taxing power. It is rated AA, AA2. So it's not just an investment grade, it's a solid investment grade. And they're able to raise billions of dollars.
So I'll just share my thoughts. And I've been working with some colleagues on these Florida programs lately. We actually have a report coming out soon. Florida's done something interesting. They have 3 public insurance programs. They have one that provides insurance like we were talking about before, direct to households and businesses, wind cover or homeowners coverage. They have what you were talking about, the only state reinsurance program. And then they also have a guarantee fund that pays the claims of bankrupt insurers. Okay, all 3 of them are set up just like you said, which is when they face claims that they can't pay from their surplus, the amounts that they have held or from their incoming premiums, they are designed to issue bonds and pay back the debt with assessments on policyholders, but not just their own policyholders. They can assess any property policy throughout the state with the exception of flood and I think medical malpractice. That means in practice, something that I'm not sure all Florida residents are aware of, maybe they are, that if you are a homeowner in North Central Florida and you have a car, your auto insurance is going to be assessed to pay the claims from the next big hurricane in Miami. And so there's a lot of cross-subsidization of risk going on. That's how the program's set up. But to your point, to come back to the question about where this intersects with the bond market, what we've been looking at in our work is that those 3 programs are managed independently right now. But a really bad hurricane season or a couple storms in a season or a couple bad seasons in a row is going to mean all 3 programs go to the bond market at the same time. And there's going to be a debt clash. Our investors in a terrible post-storm environment going to be wanting to give as much capital as needed to 3 bankrupt programs? Are they going to demand a lot more money for it? Like my bet is yes, but I don't know. And then policyholders in the state are going to be assessed from all 3 of those, spiking insurance premiums going forward where they're already the highest in the country. You can see by my tone, I think this is a little bit of like for risk management. And nobody's kind of managing for that risk. So what happens when investors don't give them enough capital or it costs too much? That's when I think there's pressure for the state to step in. What if it's too big for the state? Florida's congressional delegation in years past has already tried to get the federal government to back Florida's bonds. So then we're moving to the federal government coming in again.
I mean, you can push back on the SEC disclosure, but this is really about, are you actually telling investors? Are you doing all the modeling? Are you actually doing this? I mean, and maybe this is sort of a way to wrap up. I mean, you have those bonds being issued. You have Miami, which, for example, is acknowledging, up to 2 levels of sea level rise, but is still selling 30-year bonds without proving that there's going to be 30 years of revenue. Is our state and local governments, our infrastructure really prepared, do you think, to handle this risk, or is it all too short-sighted and rating agencies, everyone else, thinking too short in terms of the true long-term risk of what we're talking about?
I mean, I think maybe some of the points you both raised, we're starting to be at a tipping point where more of this risk is getting priced into markets, but we're still not nearly close enough, right? I mean, the examples you both gave, like, no, we're not pricing the long-term risk of what's projected, and certainly not all those potential new risks that aren't even on people's minds right now. I'm worried about things like what happens when there's a big salinization event and a major city loses drinking water, right? Like those types of things are going to really impact livability and housing markets and mortgage markets. And so I don't think we have a comprehensive understanding or accounting for them. And part of it comes back to how some of these systems are designed to work. Insurance is a 1-year policy. Insurance doesn't price future risk. It's never going to price future risk. It prices this year's risk. So how do we get future risk into housing and mortgage markets, say, or bond markets, right? And so I don't think we have developed the policies to go along with better risk-based pricing to protect the most vulnerable. And we need to kind of be doing both at the same time.
So it's not just bringing forward the risk, it's bringing forward in an equitable fashion the resiliency that we need for our communities.
Exactly.
Well, thank you so much for this deep dive on insurance and all the great ways that we're going to positively impact, hopefully, that insurance changes can drive change in our markets, but also, as I said, in our communities. And we've seen that in the work that you've done in New York with impacting communities. So thank you so much.
Thank you. This was a great conversation. Thanks for having me.